Hey everyone, welcome to the Sydney Listings Academy once again. This is our video on the investment life cycle. So a bit of a different format today to help with this particular topic. So our outcomes are to, as you can see, provide generic investment strategy outline that can be adapted toward individual needs, to offer a perspective of what investment types may be useful for particular goals or stages in an investment or retirement strategy. Okay, and this is obviously most useful for investors or property investors. So if that's you, pay particularly close attention. You might learn something useful. So what we're talking about today, and I'll just minimize again a little face here, is this, basically this line. Okay, so what you're looking at is the typical kind of life cycle of an investment strategy, particularly for someone whose goal is to retire in say 25 years. That's what you're looking at. And if it looks confusing, don't worry, we're going to unpack it quite a bit over this video. But yeah, this is obviously one of the most common goals of investing. Most people will follow very similar life patterns in terms of getting married, whatever, but also working with the goal of retiring so they don't have to work, replacing their income with some other stream. So that's what we're looking into, a generic way of doing that, okay? Because what an investment journey will look like as we'll go through at the end will always depend on the goal. So that's something we always hammer home, is that the goal is always the most important thing to have first. What do you actually want to do in your life that you need property investing or any other type of investing to help you, to use as a tool to get towards that, okay? And what you're looking at here, basically, we'll go through it to the next slide somewhat, but basically looking at, okay, we've got the wealth, so the total, I guess, worth of the assets over here on the left of your screen. The right, we're talking about that yield. So we're talking about how much cash is actually regularly coming in, generated by these investments, whatever they might be. Okay, so yield. So net yield is obviously the net income of the property. So after for example, for a property, the rent, take out the expenses for a year, you divide that by the value of the property, gets you your yield. So we're using about a 5% yield. Okay, now just this slide is just showing that what we're talking about on the left. And with this trajectory, right, if we're looking at some asset base worth about 1 million here, ends up at about 4 million over 25 years, it's about a 5.7% annual compounding growth. So the value of all this, on average, obviously it's not the same every year, because we see how the graph moves up and it bends a bit, but it's roughly the sort of growth. So that could probably be bettered normally under most market conditions. If you're in Sydney, we're not set for a boom anytime soon. Probably start to see steady growth. Not my position to know exactly what that is, but it's just a rough guide for this example, okay? Being conservative. All right, again, talking about that yield. So we're using a 5% yield here. So we've got, if you work that out, 200,000 divided by 4 million. So say that's an annual income amount there. Divide by that 4 million. That'll give you about 5%. And we're talking about net, okay, because we're taking into account expenses coming out of that. Because if your goal is to have a certain amount of passive cash income through investing, so again, if you're retiring, that's one of the things you'd want, is to have cash available rather than necessarily just equity, potentially. You'd want to know what that's going to be after your expenses. If you're relying on cash, but then all the expenses soak it up, it's not too useful it's definitely not useful for you. So that's why you'd be very cautious taking into account what expenses you're exposed to when you're thinking about this sort of strategy. All right, we're just using a conservative 5% yield here to work this all out. Sorry. Okay. All right, so we've just muddled this, but let's go back a bit. All right, so you've got some phases that you go through here on this journey. So just the lines are meant to separate a bit. So here, the focus is more on growing, okay? So again, this is a generic example based around your typical working salary individual who wants to eventually replace the income of their job with investment income so that they can retire early, whatever the goal is. Work less, work differently, whatever it might be. So here, because they've got income coming in, there's more of an emphasis on growing. Okay, so if they've got income they can service, they might be able to take out, whether they're buying properties or whatever they're doing, however they're investing, they have more of a capacity to take on negative cash flow if it means that the property's going to grow more. All right, so as long as that doesn't threaten their whole, doesn't put too much stress on them, they're more in a position to do that. Okay, whereas someone else who doesn't have that sort of income regularly coming in might not be able to pursue growth as aggressively, because sometimes the best growth opportunities do not have the best yields on them, do not have as much rent compared to how valuable they are. Rationalizing is then talking about converting that growth into cash flow. Okay, because a lot of investments, we'll talk about this to come, will be better. They'll be more useful for how much cash flow they create for you rather than how much they're going to grow over the next 5, 10, 15, 20 years. Then if you're retiring, you can look at, okay, well, I want to turn these investments I have into more cash flow for me. And then you'd enjoy the cash flow stage where, okay, you probably still would get some growth if you've got assets, if you've got properties, for example, but it's not really the goal. The main thing is, if you're retiring, you just want something to live off. Eventually, we're all going to end up in the ground or wherever. I know, sorry to be a bit grim, but you don't need some massive net worth in the grave. Okay, we're doing it for a goal, which is so we can actually enjoy it, and this is the enjoyment phase. Right? You need to convert it into cash flow. Okay, so hopefully that's clear. So if we break down the 3 typical phases with this, again, generic strategy, not for everyone. It's not for me, for example. It's not my goal. But growing your deposit for entries, the first stage, focus on capital growth, and then focus on cash flow and yield. Okay, pretty straightforward. We'll go through these 3. All right. Now, the investments at each stage. Okay, so this is where it gets more specific to each one and talking about what's available. So this is why it's not necessarily the right. Most people are like, I've got to have a bit in shares, I've got to have a bit in property. Why? Like, what's going to perform best for you? What's going to work best for your strategy? You got to think about it. And I'm not necessarily an expert in all these different things, but this is what they're generally useful for and what you're looking for at these stages. Okay, if this is like the journey you're on. All right, so let's focus on this growing deposit for entry stage first of all. Okay, so if you're growing a deposit, so this is before, say you're buying a property, all right, as the first investment you're saving up for. The first thing you're going to do is you need a deposit for that. So, in the last couple of years in Sydney or Australia, there was a change in the sort of minimum deposit rules. There's been some talk in the recent election at the time of this video about incentives for some first home buyers, and things like that. Who knows? But at the moment in Sydney, you normally need about 20% as an initial deposit. So sometimes it can be hard to figure out, do I save more money, buy a better property, or do I put the deposit I have in a cheaper property now? Well, it kind of depends. So one thing that you could look at is how fast you're saving money versus how fast, if it's property, how fast property is growing. Because if property is growing faster than your savings can, then it makes sense to get into property earlier maybe. Whereas if your savings is outperforming the market, which for a lot of people it might at the time of this video, to be honest, then you're probably better off saving. Or you can actually grow that deposit while you're saving. So things like index funds, term deposits, incredibly low risk, not that great return as a result, but it's still a return. All right, so you're basically speeding up your savings rate to break into the right growth assets. Okay. So think about it this way. If, looking at just a simple example of if you put some money in a term deposit, right? Say it generated you a 4% return, whether it was 6 or 12 months, whatever the time frame was. If you had 50,000, you've just gained 2,000. Right? Obviously, you've got to think about if there's any fees or anything associated with that. But just taking a bit of extra effort to boost your piggy bank by looking at what low risk growth opportunities there are available. Again, they're very low risk, so it's not like actually jumping into the property yet or the share market or whatever else. Okay, so that's the stuff used to grow your deposit to kind of break in. Then the focus on capital growth would be next. Okay, so when you're focusing on capital growth, so normally you focus on residential property. Okay, not necessarily just residential property. Obviously, it's pretty blanket, this stuff, but typically residential property has more of a attraction for growing, for delivering more capital growth return, especially when they're already built properties normally. So normally not new properties. They're normally a bit more expensive. You don't see as much value most of the time. And I guess normally in capital cities, or if in regional areas, they have to be picked very selectively at their cycle phase. Okay, so we've broken that down here in the slides. And we've got obviously other resources about how to look for these kind of properties. You always got to think about owner-occupier appeal. Owner-occupiers are the people that create the value in a home. If more people want to buy it, the demand goes up. So you're owning it. Even though you own it, you're not living in it. Well, you could be, but even though you're not living in it, the tenant might be paying rent. Great, can help you hold it. But really the value, if you're talking about capital growth, it's going to come from other owner-occupiers wanting to buy that property. And then we keep going, okay? Focus on cash flow and yield. Okay, so here, you get into more, there's a lot of different products that you can probably look at. So if we're talking about property, which is my main hat that I wear, commercial property is normally very attractive for the income stream it can generate. But you got to be very careful with commercial property. It's harder to get the lending. There's more regulation on the finance for that. You got bigger vacancy rates. You got some other expenses to take into account, especially if you've got a vacancy rate. So you got to think about that. High yielding residential properties, blue chip shares with strong dividends, bonds, index funds. There's a lot of things that can obviously deliver you a good cash return. So whatever it is, that would be your focus when you get to that sort of retirement phase, if that's the strategy. Very simple. So going through that again, just to recap, got that growth phase, say it was 15 years, it might be optimistic, I don't know, but you really got to be able to hold anything you've bought for growth. You obviously got to be able to hold it, right? Because you're not getting that rental return, right? You're not quite getting the rental return you get up here. So you want to make sure you're able to hold on to it. That's always an important thing. Then you rationalize, you convert it into more cash flow assets, depending on how the portfolio is structured, to make sure that you're hitting whatever number you've figured out you might need for a retirement income. That gets technical. If you want help with that, talk to financial advisors, property investment advisors that are more specified. There's a bit of math that goes into it. Okay, so I just thought I'd chuck in a few examples at the end here of a different sort of looking strategy. So for someone who wanted passive income a lot earlier, that was their real focus. For whatever reason, just trying to think what sort of, might be someone who's averse to risk and doesn't want to chase large properties. They might be lower income and only be able to afford properties that have a good yield so that the rent will help them out. This is what that sort of cycle could look like. It could be rational, essentially rationalizes a lot earlier. Whereas you might have someone else who's more of a growth person, like a family wealth kind of strategy, or a major developer, maybe like your Harry Triggerboffs of the world, people like that. They can chase this sort of trajectory. Right? Their yields might get really compressed at the end, but depending on how it's structured. Okay, but this is their major goal. All right, continual exponential wealth. This is not appropriate for everyone, and I think this is probably what a lot of people think about when they think about investing. But again, depends on your goal. You don't need to take that into the grave. That's a lot of stress to get there. It's a lot of stress and a lot of work. It might not be your specialty. You don't need to do that necessarily. Okay, what's the point in doing that if it's just going to burn these years, right? There's a lot of years that go into getting that exponential. So that's just an example to make you think. Okay, so recap, find the right properties or opportunities for you. Use rent to, at the very least, be able to hold properties long term. Make the most of capital growth if it fits that strategy of yours. Sorry, disclaimer, obviously, this advice is generic. It's not to be used by individuals, so it's just to get you thinking, all right, asking the right questions. We can connect you with certain people to help you take this further. We take no liability for misuse of this information. Encourage you to seek out professional advice, as I said. Okay, so if you like this video, if you've checked out other stuff in the Academy or relevant to Sydney listings, there's two things I really ask, if it's possible at all, to share this with friends, families, and followers. So if you have any of those three, hopefully you've got at least one of those three. Look, we really appreciate it. Obviously, you know, we're trying to do a good thing. We run our business as well, but if it creates value for people, we really want to be able to amplify the people we can reach and help. Is always fun, as well as working on our business. The two are very much aligned. And then just keep in touch. Follow us on Facebook, Instagram, LinkedIn. Check out our website, our blogs and stuff like that, and just stay in touch with the scene. That's all for me. Thank you very much. And yeah, look forward to hearing from you.